Good evening, and welcome back to another video of Grey Man's Profits for advanced learners. Today's an easy one and a very quick one. How do insurance companies actually make money? And no, it's not just off the premiums. So, let's get into it. So, let's say this is you. You're an individual that has decided to take out insurance based on claims. Let's say it's for your house, for your car, or even life insurance. This is how they turn your money from a 0% interest loan that you've given them basically into billions of dollars per year. Let's do this. So, you're an individual that gives your money to a corporation. And instead of holding on to that money for a rainy day, which of course, one disaster, it doesn't seem like they would make money. Saying that of course, they make, let's say, $500 million a year from the premium claims. But when they actually get a payout and they have a natural disaster, it can cost them billions. Surely that would just mean that one bad year and the entire system falls apart. Not exactly. So they invest in something called a float. So the float is 10% of liquid cash that they keep on the side, just here, which is basically their cash on hand that they can give out for small claims. The rest is put into outside investments. They invest in other hedge funds. They invest in property. They invest in the stock market. And more importantly, they invest in foreign exchanges. So that they make money on the side. How does this work? So, you give them money with no interest in return other than the claim. So, in other words, they have interest-free loans. They turn into an empire. And the best part about this is when it finally does come down that a natural disaster happens, the claim here is more and it exceeds the amount of the stable liquidity. All they do is they go to a bank and they go, hey, we have billions of dollars of assets that are right now, they're appreciating. So we're going to borrow against it. So they get their buddies on Wall Street to write a huge check. It may be a 3 to 5% loan, which realistically sounds like a lot when you've got billions of dollars, but it will never outweigh the amount of appreciating assets that they have. So they take that borrowed money and they pay out the rest of the corporations. And if this money or payout exceeds the amount that they are able to capitalize from interest loans based on their outside investments, they have unlimited bailouts, meaning that the company can just go, okay, we're bankrupt this year, and they can start up after the statute of limitations and keep on going after about 5 years. How does this affect the market? So, you see all those massive order blocks and you go, who the hell am I betting against that is buying 1 million shares, 100 million shares, 200 million shares of a company for an aggressive move and a huge order block that takes us out? Most likely, it's one of these companies. So, an insurance company is not actually about insurance. They're a gigantic investment firm. Hope you guys have a great evening and welcome to the Grey Man's Profits.